Welcome to our session on intercompany eliminations. This training guide is designed especially for those working in financial planning and analysis. We'll cover the mechanics of profit and loss statements, the process of eliminations, how to ensure policy compliance, and we'll explore real-life scenarios to put everything into context. By the end of this workbook, you'll have a practical understanding of how intercompany eliminations work and why they are so important for accurate financial reporting. Let's dive in. On this slide, I'll outline the key topics we'll be covering. First, we'll dive into what intercompany eliminations are and why they're necessary. This is crucial because the consolidated profit and loss statement for a business unit can't simply be the sum of all individual site revenues. Understanding this helps prevent double counting and ensures accuracy. Next, we'll explore how to handle 3 common real-world scenarios, including the tricky situation when work hasn't been invoiced by the month-end cutoff. This will give you practical guidance on managing timing differences in transactions. Then, we'll discuss the 5 golden rules of intercompany accounting. These are fundamental principles that apply to every transaction, and we'll also look at what happens when these rules are ignored or broken. Finally, we'll cover common errors and red flags to watch out for. I'll highlight 6 key checks you should perform during any intercompany P&L review, supported by real-life examples to illustrate potential pitfalls. This will help you spot issues early and maintain clean, reliable financials. Here we're looking at what an intercompany elimination means in financial reporting. Essentially, it's the process of removing internal billing between sites when consolidating financial statements, so we avoid counting the same revenue twice. In this example, Site 1 is the performing site, it actually does the work. Site 2 is the billing site, which holds the customer contract and sends the invoice to the customer. Site 2 bills Site 1 for $95,000 internally, while the customer is invoiced for $100,000. Without elimination, the business unit would report revenue of $195,000. That's $95,000 plus $100,000, even though the customer only paid $100,000. By applying the intercompany elimination, the internal $95,000 invoice is removed from the consolidated profit and loss statement. This ensures the business unit reports just $100,000 in revenue, reflecting the actual external transaction. In other words, the elimination keeps our financial results accurate by showing only one deal and one true revenue figure. On this slide, we focus on the 2 key profit and loss lines that are crucial for intercompany eliminations: internal revenue and internal cost of sales. Internal revenue is recorded by the performing site, which we call Site 1, when it raises an invoice to Site 2 for the work completed. It's important to note that this entry must come from an actual invoice with the correct intercompany pricing code. It should never be an accrual. On the other hand, internal cost of sales is recorded by the billing site, or Site 2, when it receives that invoice from Site 1. Similarly, this entry must be based on a received invoice and not an accrual. For a smooth and accurate elimination process, the internal revenue recorded by Site 1 must exactly match the internal cost of sales recorded by Site 2. Since these amounts derive from the same invoice, they should always be identical, ensuring the intercompany numbers cancel out cleanly in consolidation. This matching is essential to maintain the integrity of the financial statements. Here we have the 5 golden rules that govern every intercompany transaction. First, the seller or performing site always prevails. This means the site that completes the work must book the revenue first. The billing site then follows that invoice. It's important to book the transaction first and handle any disputes separately afterward. Second, never accrue to intercompany accounts. Internal revenue and cost of sales should only come from actual invoices. The system is designed to eliminate matched invoices, not accrual entries, so accruals can cause issues. Third, always follow your company's invoicing cutoff dates. If work is completed after the cutoff, like WD5, it should not be invoiced intercompany for that month. If necessary, use an approved workaround to stay compliant. Fourth, use the correct intercompany processing code, or ICP code, on every invoice. These codes are crucial because they trigger automated eliminations. If a code is missing or incorrect, it leads to no elimination and can misstate your business unit's profit and loss. Finally, communicate with your counterparty before month end. Proper coordination helps avoid surprises that can cause mismatches, missed eliminations, and unwanted audit risks. Keeping these rules in mind ensures smooth intercompany transactions and accurate financials across the board. Here we have the four-column model, which is fundamental because every scenario follows this structure. Once you understand it, you can apply it consistently across different situations. Starting with Site 1, known as the performing site, this is where the actual work happens. It incurs labor and production costs, then bills Site 2 through an intercompany invoice. Site 1 records this as internal revenue. Next is Site 2, the billing site. Site 2 holds the customer contract and is responsible for billing the external customer. It also accounts for Site 1's invoice internally as a cost of sales. Then we have the BU Elims, which stands for elimination. This step removes both intercompany transactions from the picture, so internal revenue and internal cost of sales are recorded as negatives here, effectively canceling each other out to zero. Finally, the full deal column shows the consolidated view, the actual results the business unit reports. Only external revenue remains because the intercompany lines net to zero, reflecting the true economics of the deal. A critical rule to remember is that after eliminations, both internal revenue and internal cost of sales must be zero in the full deal column. If they're not, it means the eliminations haven't been fully completed. As an example, if Site 1 charges Site 2 $95,000 and Site 2 charges the customer $100,000, the full deal reflects $100,000 revenue, $45,000 profit, and a 45% margin. This model helps ensure clarity and accuracy in representing the financials of these transactions. Here we have a worked example of the four-column model, illustrating the financial interaction between two sites. Site 1 charges Site 2 $95,000, while Site 2 bills the external customer $100,000. Looking at the profit and loss lines, Site 1 reports internal revenue of $95,000 from invoicing Site 2, with labor and production costs totaling $55,000, resulting in a gross profit of $40,000 and a margin of around 42%. On the other side, Site 2 recognizes external revenue of $100,000, but also records internal cost of sales of $95,000 paid to Site 1. This leaves Site 2 with a much lower gross profit of $5,000 and a margin of 5%. However, when we eliminate the intercompany transactions between the two sites, shown in the BU Elims column, these figures net out, leaving the full deal with total revenue of $100,000, total costs of $55,000, and a gross profit of $45,000, which corresponds to a 45% margin. This baseline reference ensures that intercompany revenues and costs are properly offset, giving a clear and accurate picture of the overall profitability of the combined transaction. It's crucial for presenting a transparent and consolidated view of the financial performance. Let's look at Scenario A, where the work was completed before the intercompany invoicing cutoff date. Here, Site 1 has completed all the labor and materials, with costs of $45,000 and $10,000 respectively, so the work is fully done. Site 2, which holds the customer contract, will bill the customer $100,000 for this work. Now, Site 1 can issue an intercompany invoice to Site 2 for $95,000, reflecting the combined labor and material costs. Since the work was finished before the cutoff, this standard intercompany invoice can be generated within the current month without any issues. This scenario highlights the importance of timing in invoicing to ensure proper accounting and avoids complications arising from mismatches. Next, we'll explore the correct treatments and common mistakes associated with timing mismatches in this process. Here we have Scenario A, which represents the full deal correctly invoiced. The key point here is that Site 1's internal revenue of $95,000 exactly matches Site 2's internal cost of sales for the same amount. This balance is crucial because it allows the internal eliminations to zero out, preventing any double counting. Looking at the numbers, the customer invoice raised is $100,000, recorded as external revenue by Site 1. Internally, Site 1 invoices Site 2 for $95,000. Site 2 then reflects that as an internal cost of sales, also $95,000. When we consolidate, these internal transactions cancel each other out, leaving us with the full deal figures. On the cost side, Site 1 records labor costs of $45,000 and production costs of $10,000, totaling $55,000 in direct costs. Site 2 doesn't have additional direct costs in this scenario. This leaves a gross profit of $40,000 for Site 1 and $5,000 for Site 2, totaling $45,000. The overall gross margin for the full deal is 45%, which aligns perfectly with the ideal end state. In summary, this scenario demonstrates the correct invoicing and accounting treatment, ensuring accurate revenue recognition, proper internal cost elimination, and a clear reflection of profitability at the full deal level. In this scenario, we're looking at a timing mismatch where costs have been incurred, but no invoice has been issued yet. Site 1 has recorded labor costs of $45,000 and production costs of $10,000, bringing total direct costs to $55,000. However, there is no corresponding revenue recognized at this point, resulting in a negative gross profit of $55,000. It's important to understand that this situation represents a timing gap rather than an actual economic loss. The full deal also reflects this $55,000 deficit. Because the revenue hasn't been invoiced yet, Site 1 has essentially absorbed these costs temporarily. Crucially, we should not accrue internal revenue to offset this timing difference, as doing so would violate Rule 2. This means we have to carefully manage and track these timing mismatches to ensure accurate financial reporting without prematurely recognizing revenue. In this scenario, we have a clean elimination with the correct treatment of the invoice raised. Looking first at Site 1, external revenue is zero, but there is internal revenue of $95,000 from the invoice to Site 2, which was issued before the cutoff. Site 1's labor costs amount to $45,000, and production costs are $10,000, leading to total direct costs of $55,000. After subtracting these costs, Site 1 shows a gross profit of $40,000, which translates to a healthy margin of 42.1% on the intercompany transaction. Switching to Site 2, external revenue is $100,000 from the customer invoice. Site 2 incurs an internal cost of sales amounting to $95,000, which is the invoice received from Site 1, and there are no direct labor or production costs here. This results in a gross profit of $5,000 with a margin of 5% on the customer deal. When we look at the full deal, combining both sites, the total revenue is $100,000, total direct costs are $55,000, and the gross profit is $45,000. This computes to an overall margin of 45%. The key takeaway here is that both intercompany lines effectively eliminate to zero, ensuring a clean result that accurately reflects the profitability of the entire transaction without any double counting. This clear separation and elimination are critical for reliable financial reporting. Here we have Scenario A, which highlights a critical policy violation. Both sites are booking external revenue, but Site 1 is doing so without having a valid customer contract. This leads to a revenue overstatement, which is a serious issue. Looking at the numbers, Site 1 records external revenue of $10,400, but this is incorrect because there is no contract supporting this booking. Site 2 also records $10,400 in external revenue, and when combined, the full deal shows $20,800. This amount is double the actual customer payment of $10,400, which is a fatal error. Additionally, Site 1 does not have an intercompany invoice to justify this revenue, meaning there is no internal elimination, causing the total revenue to be artificially inflated. The labor and production costs for Site 1 are recorded correctly, but the mismatch between revenue and costs due to the incorrect booking impacts the gross profit and margin calculations. The key takeaway is that Site 1 should never book external revenue without a customer contract, as this leads to both compliance issues and financial misstatements. This scenario clearly shows why avoiding such practices is essential to ensure accurate and policy-compliant financial reporting. In this scenario, Site 1 accrues internal revenue, but this is an incorrect option and represents a policy violation. Specifically, the accrual has been posted to intercompany accounts, which violates Rule 2. The key issue here is that the system will not automatically eliminate accruals since they lack an intercompany process code. Looking closer at the numbers, Site 1 shows internal revenue and an accrual with no invoice raised, while Site 2 records a corresponding offsetting amount. However, because this accrual does not generate an invoice, the system cannot reconcile or eliminate these amounts automatically. This misalignment poses a risk. If the actual invoice value differs from the accrual, it will lead to inaccuracies in the business unit's profit and loss statements. Even though the full deal appears balanced on the surface, reflecting a correct total revenue and cost alignment, the underlying issue with accruals not being matched by invoices compromises the integrity of financial reporting. It's essential to follow Rule 2 to ensure that all intercompany transactions are properly coded and invoiced, enabling the system to perform automatic eliminations and maintain accurate business unit P&L data. Here, we're looking at Scenario B, which deals with work completed after the invoicing cutoff date, following a compliant approach. The key point is that no intercompany accounts are accrued, keeping us fully compliant with policy. In this case, Site 1 completes work worth $34,000 on the very last day of the month, but after the invoicing cutoff. Since they can't raise an intercompany invoice this month, the solution is to temporarily book that $34,000 as external revenue through a manual journal entry. Then, in the following month, Site 1 reverses that entry and raises the intercompany invoice, while Site 2 invoices the customer. This way, the economics properly land in month 1, reflecting the work done, and month 2 nets to zero, ensuring accurate financial reporting without violating any compliance rules. Here, in Scenario B for month 1, Site 1 books external revenue temporarily. This is fully compliant because no intercompany accounts are affected during this process. Looking at the P&L, Site 1 records $34,000 as external revenue for the full deal. The labor costs are $20,000 and production costs are $5,000, resulting in total direct costs of $25,000. This leads to a gross profit of $9,000, representing a margin of 26.5%. Site 2 does not take any action this month, and there are no eliminations between business units at this stage. Importantly, this is a temporary journal entry, which must be reversed in month 2 when the actual intercompany invoice is issued. This ensures accurate financial reporting without distorting intercompany balances. Here in month 2, we see the reversal of the accrual from month 1, which is why there's a negative $34,000 under external revenue for Site 1. This reversal is balanced by the customer invoice issued, which offsets that amount. On the internal side, Site 1 raised an actual intercompany invoice for $34,000, and Site 2 received the matching invoice, reflected as a $34,000 internal cost of sales. When we consolidate the full deal, the total revenue and total direct costs cancel each other out, resulting in a net zero gross profit and a 0% gross margin for Site 2. This is exactly what we expect since all the economics were already captured in month 1. It's important to communicate this clearly to management before the report goes out, so there's no confusion about the zero margin for month 2. Essentially, month 2 is just about settling the intercompany transactions and confirming that everything aligns as anticipated. Here we have the combined view for month 1 and month 2 under Scenario B, showing the true economic result of the full deal. Starting with external revenue, we see a total of $34,000, which is consistent across both Site 1 and Site 2. It's important to note that this figure is net of accrual and invoice adjustments. Looking at internal revenue, Site 1 reports $34,000, again net of reversals and invoices, while Site 2 and the business unit eliminations balance each other out to zero, keeping the consolidated internal revenue at zero. Moving to costs, labor expenses at Site 1 total $20,000, with no associated costs at Site 2 or eliminations. Production costs at another $5,000 at Site 1 only. Internal cost of sales at Site 2 is offset by a corresponding elimination of negative $34,000, which maintains the integrity of the consolidation process. Summing these costs, total direct costs amount to $25,000. This leads us to the gross profit, calculated at $9,000, with a healthy gross margin of 26.5%. Notice that both intercompany lines are effectively zero, which highlights that all internal transactions have been properly eliminated for a clear picture of the true economic performance. Overall, this combined two-month view presents management with a transparent, consolidated financial snapshot: $34,000 in external revenue, direct costs of $25,000, and a resulting profit of $9,000, maintaining a solid margin. This ensures that decision-makers see the real economic outcome without internal distortions. In Scenario C, we're looking at the Interco accrual approach, which is actually a policy violation and is for reference only. The key point here is that the policy status is non-compliant because the intercompany account is being accrued, which breaks Rule 2. This situation is similar to what we saw in Scenario B, where the work is done after the cutoff date. The difference here is that Site 2 accrues both the external revenue of $34,000 and the internal cost of sales of $34,000. Meanwhile, Site 1 raises the actual intercompany invoice, which is the correct part of the process. We include this scenario so you can spot this approach when you see it and understand why it must be changed to align with the policy. Here we have Scenario C where, in month 1, Site 2 accrues an intercompany cost, which is a direct violation of our policy. Specifically, Rule 2 is breached because Site 2 records this cost as an internal cost of sales, which is an intercompany account. The key issue here is that the system is unable to automatically eliminate this cost. Looking at the profit and loss breakdown, Site 1 shows external revenue of $34,000 with an actual invoice raised, so this part is handled correctly. Meanwhile, Site 2 records internal revenue of $34,000 but accrues an internal cost of sales of $34,000 as well, without an actual invoice or an intercompany process code, which is the root of the violation. When we consolidate at the business unit level, the BU eliminations include a negative $34,000 to offset the intercompany revenue, but because the accrual in Site 2 is not linked properly, the system can't process this elimination automatically. As a result, while the total direct costs balance out to $25,000 and the gross profit appears to be $9,000 with a margin of 26.5%, the internal mismatch means the business unit profit and loss statement will be incorrect. Essentially, even though the numbers may look identical to Scenario B, this improperly accrued intercompany cost without an ICP code leads to potential discrepancies. This highlights the importance of following the policy strictly to ensure system-driven automatic eliminations and accurate financial reporting. Here we have a side-by-side comparison of Scenario B, the external revenue workaround, and Scenario C, the intercompany accrual approach. Looking at policy compliance, Scenario B is fully compliant, whereas Scenario C is not compliant due to the intercompany account accrual. Both scenarios report the same full deal revenue and profit for the first month, $34,000 in revenue and $9,000 in profit, which is a 26.5% margin. When it comes to elimination risk, Scenario B poses a low risk because it relies only on actual invoices, while Scenario C has a medium risk due to potential mismatches between accruals and invoices. The system auto-eliminates Scenario B transactions using ICP-coded invoices, but Scenario C does not benefit from this automation, requiring manual intervention. Regarding manual journal entries, Scenario B needs one journal entry and one reversal at Site 1, whereas Scenario C demands 2 journal entries and 2 reversals at Site 2. This adds complexity and increases workload. Audit and compliance risk is low for Scenario B, but high for Scenario C, since it breaches policy. Based on all these factors, Scenario B is the recommended approach. It achieves the same profit and loss result as Scenario C, but with lower compliance risk, fewer journal entries, and the advantage of an auto-elimination safety net. Therefore, it's advisable to use Scenario B over Scenario C. Here are 6 key red flags to watch for when reviewing intercompany profit and loss statements. First, if you see intercompany cost of sales recorded without a matching intercompany revenue, it could mean Site 2 booked costs without receiving an invoice. In this case, check for missing accruals or an incorrect intercompany pricing code. Second, the reverse situation is also a red flag. Intercompany revenue recorded without a corresponding intercompany cost of sales. This might happen if Site 1 issued an invoice, but Site 2 hasn't recognized the cost yet, possibly due to wrong coding or timing differences. Third, if non-zero intercompany lines remain in the full deal elimination, it suggests the elimination process didn't clear properly. This could be due to mismatched amounts, missing codes, or one side recording accruals without corresponding invoices. Fourth, external revenue appearing at the performing site could be either an intentional workaround scenario or an error. It's essential to verify if a reversal has been made and confirm which case applies. Fifth, zero revenue at Site 1 paired with costs and no reversal might point to a timing gap from a previous month that wasn't closed out. It's important to check whether the reversal from any prior workaround was properly posted. Finally, if the full deal margin is significantly off from what you expect, it's usually due to incomplete elimination. Always cross-check Site 1's intercompany revenue against Site 2's intercompany cost of sales. These numbers must align perfectly. By keeping an eye on these 6 red flags, you can ensure more accurate and reliable intercompany financial reviews. To wrap up, there are 3 key takeaways I want to emphasize. First, eliminations are crucial to prevent double counting. Remember, the business unit only recognizes revenue from external customers. So, any intercompany invoice must be removed before we consolidate the P&L, ensuring that both internal revenue and internal cost of sales are zero in the full deal. Second, avoid accruing to intercompany accounts. Our system relies on actual invoices to auto-eliminate entries, and accruals don't have intercompany partner codes. So, always use actual invoices, or if you've missed the cutoff, apply the compliant external revenue workaround we call Scenario B. Finally, if work misses the cutoff, Scenario B provides the proper solution. This means temporarily booking external revenue at Site 1, reversing it the next month, and then raising the intercompany invoice. This approach is compliant, auditable, and ensures the economics are recorded in the correct month. For all the detailed tables and a full analyst checklist, please refer to the training workbook.